This is a graph that often surprises me. If we adjust UK house prices for inflation, then they are the same level as back in 2003. In other words, you bought a house in 2003, ignore the effects of inflation, and the average house value hasn't changed at all. In fact, house prices are 15% lower than the start of 2022 and 23% lower than their 2007 peak. Why does this surprise us? Well, it doesn't feel like house prices have fallen and become cheaper. And compared to income, house prices are still in fact really quite expensive. Despite some very modest declines since 2022, the ratio of house price to incomes is pretty close to record levels, higher than the 2007 bubble. Yet, according to Zoopla research, UK house prices are now only overvalued by around 8%. What's going on? Because despite a gloomy economic outlook, there are signs that the UK housing market at least is picking up, with strong growth in demand and greater supply of houses coming onto the market. According to the Land Registry, last year in 2024, UK house prices rose 4.6%, and this is supported by a growth in mortgage approvals back to long-term trend levels. Now, part of this very recent activity is people trying to get ahead of stamp duty increases. But looking away from the current situation, is there a hope for UK house prices to become more affordable in the coming years? Or, with interest rates set to fall, could we see yet another boom in house prices like the late 90s or even early 2020s? Well, there are three reasons to worry about another period of rapid house price growth. Firstly, interest rates are set to fall. At the start of this year, the consensus was for base rates to fall to around 3.5%. Goldman Sachs predict by 2026, interest rates could be as low as 3.25%. Now, this may not sound a lot, but a 1% reduction will still significantly reduce the cost of mortgage payments and importantly extend the range of people who are able to get their first mortgage. A further cut of just 1% on mortgage rates could see an average mortgage monthly payment fall by £150 a month. Now, what about the fact that inflation is proving a bit more sticky than the Bank of England would like? Does this mean they will have to keep interest rates higher than people predict? Certainly since last October, forecasts for interest rates are slightly higher. But there are a few things. Firstly, UK interest rates are really quite high compared to the rest of the world. US is probably going to cut rates this year, and as their economy slows, it will make it easier for the UK to cut interest rates too. Secondly, and perhaps more importantly, the UK economy barely growing. Growth continues to disappoint. And if you look at the metric of GDP, there's a strong case for an even bigger rate cut, even if core inflation remains something of a background headache for the bank. Now, despite a stagnant economy, GDP per capita is still lower than 2019. Here's another stat that might be just a little bit surprising. Nominal wage growth at the end of last year was running at 6%. So even adjusted for inflation of 3%, that's still a significant rise in real wages. Now, this rate of growth of earnings is likely to moderate over the coming year, but there is an element of wages catching up with that 2022 inflation shock. Now, wages are really very important because income is the biggest factor determining house prices, and continued wage growth will increase the buying power of first-time buyers, creating more demand. And I think the really big question is, with such weak economic growth, how long will wages continue to rise? Will the UK be able to snap out of its 15, 16-year-long stagnation? Well, hopefully it will, but it'll have a big impact on the housing market if it does. But even if the growth remains low, another long-term factor that will put upward pressure on house prices is the continued growth in the population and the number of households. Now, the number of households would actually be even higher if it wasn't for all the suppressed household formation because housing is so expensive. Basically, people having to live in bigger families, bigger shared rented properties. High levels of net migration may be set to fall compared to the boom years of just a couple of years ago, but it still will be a net upward pressure on housing demand. Now, many recently arrived migrants don't actually enter the buying a house market. They more tend to stay in the private rented sector. But that's another factor affecting house prices. Rents in England and Great Britain have been rising faster than inflation in recent years, meaning that many people face really high housing costs. And so despite high house prices, the cost of renting means there's a very strong incentive to try and buy, if at all possible. Zoopla report more renters are now looking to buy compared to last year, which is very understandable given the private rented sector is a bit of a disaster. Also, to understand the housing market, it's important to remember that one reason for the big increase in this house price to income ratio in recent years is the fact that it's not just income being used to buy houses. We've also got a lot of wealth coming into the market, in particular help from parents and family members. And this is inflating prices. In 2023, 47% of all home sales involved some help from family members. That's an extra 8.1 billion of additional spending power. But as the baby boomer generation ages, this great wealth transfer will only increase. In the coming years, the flow of wealth will rise to 150 billion a year by 2035. And of course, a lot of this inheritance will end up in the housing market. If you're paying over £2,000 a month rent and then you inherit, say, £300,000, what would you do? I know what I would do. I'd try and buy a house. So that is the bullish case for house prices in the long term. At the very least, you can expect more nominal price rises. But before we get carried away with the idea there's going to be a big rise in prices, it is worth bearing in mind a few things. Not least, this is definitely not the mid-1990s. Firstly, affordability really is stretched. This is a ratio of mortgage payments as a share of income for first-time buyers. Now, nationwide data is not perfect, but it is a rough guide to the state of the housing market. Now, that ratio is not as bad as the pre-crash peaks of 1989 and 2007, but it is still elevated compared to those periods of booming house prices. Now, lower interest rates may bring that down a little bit more, but despite relatively low rates, house prices are just as expensive. According to the ONS data, 8 times income. So even with a combined mortgage, many couples are struggling to buy. And don't forget that many potential buyers are facing different constraints to the past. In particular, as stress tests are more stringent than in the 1990s and 2000s, there's been a clampdown on things like undeclared earnings or self-certification mortgages, although high mortgage to an income multiple are making a bit of a comeback with some of the companies offering quite big mortgage multiples. But basically, it does mean you have to prove you can afford to pay a mortgage even if interest rates go up. Now, the advantage of this is that when interest rates rose in 2022, arrears remained relatively low, and this helped stabilise the housing market. But the downside is that you may not be able to get a mortgage, even if many would prefer to be paying a mortgage rather than renting. Also, there's been a removal of Help to Buy, which did a lot to support house purchases in the 2010s. Between 2013 and 2018, 38% of all new build properties were supported with the government's Help to Buy scheme, and it encouraged, by the way, an estimated 14% of all new build houses. Another thing that supported house price growth in the 2010s was quantitative easing, the Bank of England's policy to create money and buy bonds, and this saw more liquidity in the banking sector, and it was a factor in pushing up asset prices like houses. The bank's own analysis did suggest that quantitative easing had a moderate effect on pushing up house prices. But quantitative easing is now being reversed. The bank have sold over 300 billion of their bonds, and they plan to do a lot more in the coming 12 months. If QE inflated house prices, then reversing it in theory should have a negative impact on house prices too. Now, what about the plans to build 1.5 million homes in this parliament? Will this boom in house prices finally deflate prices? Well, I wouldn't hold your breath. Firstly, it's very unlikely the government will get anywhere close to meeting its target of 370,000. Government housing targets are a bit like migration targets, they never get met. The housing market is currently nowhere near that level, and it would take something of a miracle to suddenly build almost for double the current rate. Aside from a shortage of workers, the biggest problem really is that UK builders are sceptical there will be sufficient demand to buy that level of homes at current prices. Neil Hudson of Built Place estimates a shortfall of £55 billion. Now, the total value of 370,000 homes on current prices would be a market of 130 billion. But the current market is only around 75 billion. Help to Buy at its peak offered an extra 19 billion, but that's no longer around. Basically, builders will not build expensive houses only to have to then discount them in order to sell. Now, at this point, you may ask why don't you just build more affordable homes? But affordable homes tend to be less profitable and only make builders want to build less. Government provision of social homes is a really great idea, but not practical on a large scale given the woeful state of government finances. Another suggestion, why not build more high-density flats and apartments? But interestingly, demand for flats continues to lag behind that of houses. In fact, the gap between house prices and flats have reached record levels, though if you're desperate to get on the property ladder, flats do offer an entry point. Certainly, if we look at house prices, apart from short periods, it does seem to be a one-way bet, at least in terms of nominal prices. Savills, one of the few to make 5-year predictions, suggests prices will be 23.4% higher by 2029. But the highest price rises will occur in the cheapest areas in the north in Scotland, and London will see the lowest increases. Hampton's ONS predict slower house price growth, just 12% growth by 2027. But I think that the days of getting rich on buy-to-let and seeing a huge capital gains in both nominal and real house prices is, if not over, it's very hard to see in the immediate future. And of course, any prediction on house prices really depends on the state of the economy, what's going to happen to wages and incomes, one of the big determinants of house prices. This video unfortunately looks at some of the more gloomier aspects of the UK economy. Maybe things will get changed around, but at the moment it's hard to see. So I hope this video was useful. As it is, do subscribe. Always be videos on the housing market, and hopefully prices won't go up but stay stable and enable more people to get on it, help to reduce the housing crisis that we're facing. Anyway, see you soon.